The AI compute market just proved it's not hype. One major provider, Alpha Compute Corp, is now projecting significant revenue from dedicated infrastructure, showing real demand and a clear shift in the landscape. Today, we're unpacking what this means for your infrastructure strategy and why the race for specialized AI compute is heating up, affecting every builder from indie hackers to enterprise leaders. No BS AI briefing brought to you by Proactive AI. Welcome back. I'm your host Vikash, and this is where builders get straightforward AI news without the fluff. First up, a headline that really caught my eye this week. Alpha Compute Corp, or ALP on the Nasdaq, just hit a revenue milestone, announcing a staggering $200 million plus qualified sales pipeline for their AI compute infrastructure services. I mean, think about that for a second. This isn't just some startup talking about future potential. They've actually secured a $32.2 million contract already and are projecting to bring in $21 million in revenue over the next 12 months. That's a company moving from the development phase, the promise phase, into actual revenue generating operations. In plain English, this means that the demand for specialized AI compute isn't just theoretical anymore. We're seeing real world contracts and tangible revenue numbers that prove companies are willing to pay for dedicated infrastructure specifically designed for AI workloads. It's a powerful validation that this segment of the market isn't just venture capital hype. It's a foundational piece of the AI economy. For builders, the interesting part is the shift indicates that dedicated AI compute infrastructure is maturing. It's no longer purely speculative. This means specialized compute providers are becoming viable, long-term partners for handling those crucial inference and training workloads that are so central to AI products. We're talking about reliable alternatives to just dumping everything onto the hyperscalers. So, as product managers and engineering leaders, you really should be tracking these compute providers. They're no longer just niche players, they're becoming strategic partners. Their ability to deliver on these revenue projections could reshape how you plan your compute strategy, offering new options for cost, performance, and scalability. It could genuinely change your product's economics. So, let's dive deeper into why this Alpha Compute story isn't just another quarterly update. It's a significant marker for the entire AI infrastructure landscape. The core of what happened here is Alpha Compute Corp, ALP, moving from what was largely a pre-revenue or pilot phase for many AI compute startups to actually signing a substantial $32.2 million contract and projecting $21 million in revenue over the next year. This isn't just a big number in a press release, it's a concrete signal. It suggests a clear transition from an idea or a speculative play to a validated business model where companies are putting serious money down for specialized AI compute. It means the infrastructure layer that underpins all our AI applications is growing up, moving beyond just being a venture backed dream. Now, why does this matter right now for you, the builder? Well, it's a strong indicator that the underlying demand for dedicated AI compute isn't just about early adopters or internal R&D anymore. Real businesses with real budgets are committing to these services. For the market, it validates the need for alternatives to general purpose cloud providers, showing there's a lucrative niche for specialized hardware and optimized stacks. For your product, this could translate into more competitive pricing options, better performance for specific AI tasks, and potentially less vendor lock-in down the road. For development teams, it means a growing ecosystem of tools and partners to consider when building or scaling out your AI features. Who should really care about this? Honestly, if you're building anything with AI, this affects you. Founders. You should care because your burn rate is directly tied to compute costs. More viable providers mean more leverage, more options, and potentially lower costs, which extends your runway. It's about building a sustainable business. Product managers today, you need to understand the evolving cost structure of AI. If compute becomes cheaper or more specialized, what new product features become feasible? What does this mean for your pricing models or your ability to offer premium AI capabilities? Model infrastructure engineers. This is directly in your wheelhouse. It signals that you'll have a wider array of vendors to evaluate. It's time to start looking at multi vendor strategies for critical workloads, optimizing for cost, latency, or even specific hardware types like custom AI accelerators, also indie hackers. This is huge. If specialized compute can be more accessible and affordable than massive hyperscaler offerings, it lowers the barrier to entry for building and deploying complex AI models without breaking the bank. It means your side project might just become viable. How would I think about this as a builder myself? Look, the biggest opportunity here is diversification. Relying on a single major cloud provider for all your AI compute has its risks: vendor lock in, price hikes, limited hardware choices. This trend towards viable specialized providers like Alpha Compute opens up a chance to build a more resilient and cost effective infrastructure. You could use hyperscalers for general tasks, but offload your heavy AI training or inference to a specialist. It's about finding that sweet spot between cost, performance, and reliability. However, don't ignore the risks. While Alpha Compute's numbers are promising, this is still a dynamic, nascent market. Consolidation is inevitable and some players won't make it. You'll need to do your due diligence on stability and long term viability. My personal mental model is to view it like the early days of specific database providers or CDN services. They started niche, then became essential infrastructure options alongside general cloud. My Nobius take on this: the revenue traction is real and the demand for dedicated AI compute is validated. This isn't just marketing fluff, it's companies actually signing contracts. However, let's keep some perspective. Alpha Compute's $200 million pipeline is qualified, not fully signed, and a mid quarter update isn't a full earnings report. So, while it's an exciting signal of market maturity, it's not a blank check for every new AI compute startup. It tells us the pie is growing, but the slices will be fiercely contended for. If you're finding this useful, hit follow in your podcast app right now. It takes 2 seconds and it's the best way to make sure you don't miss the next briefing. If you want one practical takeaway from today's episode, here it is: experiment. Audit your current AI compute costs. It's time to really dig into where your money is going. Here's how to try it in under 60 minutes. First, pull up your current cloud bills, especially for the last 3 to 6 months. Don't just look at the total number. Instead, break it down by workload. Identify what's going towards model training versus inference, which specific models are consuming the most resources, and across which regions or services are you incurring these costs. Are you running on GPUs, TPUs, or something else? Get specific. Next, dedicate about 20 minutes to a quick search for emerging AI compute alternatives. While we just talked about Alpha Compute Corp, the market is diversifying beyond just the biggest names. Look for providers that specifically advertise dedicated AI hardware or optimized stacks, especially if you have particular model architectures or data requirements. You're not looking to sign a contract today, just to understand who the players are and what their pricing models generally look like. Do they offer per second billing, reserved instances, or specialized hardware access? Finally, compare. For your most expensive or mission critical workloads, maybe it's a specific daily inference task or a weekly model retraining job, do a back of the envelope calculation. How would that exact workload cost on one or two of these emerging alternative platforms versus what you're paying now? Don't forget to factor in data transfer costs or the effort of migration, but focus on the raw compute numbers for now. Why is this specific experiment worth your time right now? Because compute is rapidly becoming one of the largest operational costs for AI first products. Even a modest 10-15% saving can dramatically improve your profit margins or extend your runway, freeing up capital for hiring, marketing, or further product development. Understanding this landscape isn't just about saving money today, it's about making strategic decisions for your product's future, avoiding vendor lock in, and staying competitive as the AI infrastructure market matures. That's it for today's No BS AI briefing. If this helped, Follow the show in your podcast app and share it with one builder you know. And if you've got questions or topics you want covered, connect with me on LinkedIn and send them over. See you in the next briefing.